Hey, welcome back to Two Stupid Guys for Stocks. I'm Dylan.
And I'm Vinny. And holy crap, the Federal Reserve, my man Jay Powell, talked this week, put out his new summary of economic projections. And boy, oh boy, was he wrong. We're going to talk about it. Okay. I'm going to get into the data. It's amazing.
Two stupid guys, three stocks.
He was wrong.
And I got to say, I do love Jay Powell, but it is amazing. Being like the head of the Federal Reserve is equivalent to being a weatherman in that you can be drastically off, but no one bats an eye to just say it's complicated, man.
That's fair. Yeah.
Yeah.
Except I think his job is more complicated than Motherman. But yeah.
Yeah, sure. All right. But this is the headlines you're going to see from like this week's, kind of basically Federal Reserve meeting. But they held the interest rate steady, indicates only one cut coming this year, right? That's the SEP thing. We're going to look at that side by side in terms of some of the other changes that are buried within the SEP. But they basically kept their interest rates the same. They're also not changing the pace of their balance sheet, kind of sell off of assets. Remember we talked about that in the past. I didn't put the chart in here, but they've been slowly selling off assets about a tune of about $90 billion a month for a better part of like 2 years. They recently decreased that down to now it's I think 60 billion. It's 25 plus 35. Yeah, that's 60 billion. 60 billion in assets per month that they're selling off instead of the previous 90. All right, so this is the major change that was in their kind of news summary or their press release was that inflation has eased over the past year but remains elevated. Okay. The other line that's really important here is in recent months, there's been modest further progress towards the committee's 2% inflation objective, but only modest. Right. So they've
Right.
had some improvement, but still not drastic. Right?
So
Remember,
I will say, I said there's going to be one rate cut in like February. I got a lot of shit for that.
you were early.
Just throwing that
Yeah.
out there.
Yeah. You were
Uh,
early. We
no, no,
talked
no.
about it.
I'm right. There's going to be one rate
No, no,
cut.
you were, yeah, you were an early predictor of that. I think as of before this meeting, I was saying now there's only going to be one cut this year, and it's going to be in December. That was my most recent prediction. All
Yeah.
right,
And I agree.
I'm as randomly off the wall there. So this is that dot plot, the infamous dot plot. This is basically a vote of the Federal Reserve Board of Governors and where they think interest rates will be at various timeframes. And there was a shift up in effect over the last 3 months. They only do these every 3 months. So they're actually seeing a more of a concentration around this 5 to 5.25 range than you were previously. So that's implying that one rate cut this year is where that headline comes from. Okay. If you're looking at other predictions that are included in this, they predict multiple things. If you want to actually move us out of the way there, so this little dotted line, it basically is where they thought things would be as of the last time they issued these projections. And if you notice, there's a shift. All the blue is now this most recent meeting, right? There's a shift down towards the left. So basically, it's saying that GDP for this year, their prediction has come down in the last 3 months, saying the economic activity is growing slower than they originally predicted 3 months ago. Right?
Okay.
Yeah, unemployment rate. The shift is slightly up. They're predicting a little higher unemployment rate throughout the rest of this year, and that has also changed in the last 3 months as far as their predictions for the end of this year. The top row of each one of these graphs is just the end of 2024. So that's really what I'm focused on is what are they seeing happening before the end of 2024. Longer run, they tend to be a little bit more consistent because there's less certainty out there, so they're kind of more in the world of that's what I want to say here. That less change in a short-term basis, a little bit less volatile, just be a little bit smoother. PCE, their inflation, right? This is headline PCE. Their prediction in the last 3 months for the end of this year, as far as PCE inflation, has shifted up over the last 3 months.
Oh,
So
jeez.
they're saying economy slowing, unemployment's going to be higher than we originally thought, and inflation is still being goddamn freaking persistent.
Yeah.
That's what they're saying here.
It's not ideal. It's not what you want.
Nope. And same story, even more striking, right? What is the single data point the Federal Reserve loves the most is core PCE. And look how dramatic the shift was in the last 3 months from prior meeting.
Yeah, that is not ideal.
Yep.
Honestly, I feel like if they do a cut, it's just to appease people. I really don't think they should. I think because it's your biggest tool. Just don't play your cards early.
They're I would be surprised if we got a token cut. Actually, I'll save up my prediction for the end of the video once I look
Okay.
at all these slides. But look at this. Core PC shifted up in the last 3 months for the rest of this year, right? And even look at this. Out next year, they're talking about a pretty significant shift in their prediction for where core PC is, the most important kind of metric to them. That's a big move, man.
That's not good. Yeah, that's not ideal. It's not great.
And then this is their prediction for the Fed funds rate, right? This is the result of all the other data. This is where they think the interest rates are going to be. Look at this, the dotted line, right? 3 months ago. Look at the shift up. Everyone kind of moved up the ladder a little bit.
It's definitely way stickier than they thought. We did a video. We didn't really look at why it was sticky because that's complicated. But it's definitely stickier than other countries are seeing in their economies.
Yeah. That's actually the name of Dylan's autobiography. Why am I sticky?
Why am I?
That's a different question entirely. So 2025 Fed funds rate. Look at this. Now you have like the median prediction of over 4%. They're saying like 1.25% cut through the end of next year now.
Okay.
Yeah.
So one, they have shown that predicting more than 6 months out, they're worthless. So, because this is a really hard developing situation. If unemployment shoots up, in between that, they're gonna cut. So it doesn't matter. That's assuming that unemployment does not raise and the economy stays strong, which I don't know if that's gonna happen.
Yeah. So these are the dates to kind of look forward for next Fed funds meetings. All right, we only have 4 more this year. Right. So now we've taken that 3 rate cuts thing off the table. We're looking at one of these 4 potentially maybe has one. I'm still eyeing this December one here. They could do it in the November one where they're going to possibly try to spur economic activity a little bit into Christmas season, and have a little bit of a rate cut there to boost consumer confidence. That's kind of what the market's predicting here. So this is that CME Federal Funds Watch tool. They're basically saying there's almost no chance that they're going to get any rate cuts at this next meeting in July. September, saying maybe September, probably going to have one by October meeting. I'm sorry, November meeting, and then almost certainly by the Christmas one is what the current prediction from the CME Fed Watch tool is. All right, so here's what I see. I see 2 possibilities. I see we get a 25 basis point cut in either the November or December meeting. That's one possibility. That's assuming everything stays status quo. The other possibility is that they have kept rates high enough for long enough that something, we don't know what, will break in the U.S. economy, and they will cut rates very quickly to address that situation, but it'll be an emergency kind of rate cut situation. So if they're saying on their current course, November, December, before we even get a tiny bit one, and we're going to see only maybe 1% throughout the rest of 2025 now, as opposed to breaking something. Those are the 2 scenarios I see at this point.
Yeah, so I agree. I called November a long time ago. Granted, I didn't realize that they had the economic meeting, so they might do December because that's more of a bigger date. I don't see their 225. I agree with you. Their 2025 predictions being correct because I don't think unemployment or the economy is going to be strong enough to withhold that much. There's already too many. Do you follow everything whale? No. What is that? Whale watch?
Yeah, everything whales. No,
Everything whales?
Is it everything whales? No, I can't remember the name of it. I know what you're talking about.
But I swear, every week they're just like, yep, no one has savings accounts. Lowest point in 20 years. There's just like a new stat constantly. I just don't see that we're going to be fine for the next 18 months. I don't think it's going to happen.
Yeah. Crisis response is probably becoming, I think, more and more likely now than them being able to stay their course and slowly dial back these rates over the next 18 months now. We're looking before we even get back to 4% Fed funds rate. So a 4% Fed funds rate, what is that going to have 30-year mortgages at? Like 6?
Yeah. And with the increase in housing, 6 is still too high. And yes, I know in the 90s it was like 15. Prices were the same. That's not a good argument. That's a bad argument.
Yeah. All right, guys. Well, let us know your thoughts down in the comments down below. Let's get back to you.
Scary.